You know that feeling. You're sitting in front of the charts, and for a split second, you feel a tightening in your chest. It's not fear exactly. It's a quiet, nagging realization that despite all the indicators, the courses, and the late-night backtesting, you're still just guessing. Most people think fixing a trading system is about finding a better entry signal. They think it's about the what. But the moment I finally fixed my system, it wasn't because I found a new indicator. It was because I stopped looking at the screen and started looking at the person reflected in it. Today, we aren't talking about money. We're talking about the internal shifts that make the money inevitable. You think your edge is your strategy. It isn't. Most beginners focus on the win rate. They obsess over 80 or 90% accuracy. They hunt for the holy grail that never loses. But the reality is that the real signal isn't the entry. The real signal is your average outcome over 100 trades. Most people think a fixed system means every trade is winner. Professional traders know a fixed system means every loss is expected. If you are still looking for a way to be right every time, you aren't trading, you're gambling on your own ego. The moment you accept that your system is a mathematical probability and not a crystal ball, the fixing begins. The 4 shifts to system mastery. Number 1, the death of the perfect setup. The statement, if a setup looks too perfect, you should probably be more cautious, not more aggressive. Beginner behavior, they wait for 5 indicators to line up perfectly. When they do, they size up because it can't fail. Master behavior, they realize that the best trades often look messy or counterintuitive. They keep their risk identical regardless of how good the setup looks. Psychology, this is the certainty bias. Our brains crave patterns that confirm our safety. In trading, seeking certainty is the fastest way to blow an account. The analogy, think of a shop owner. They have to pay rent and electricity to keep the lights on. They don't get angry at the electric bill. Your stop losses are your electric bill for the opportunity to catch a winner. Number 2, radical acceptance of the stop loss. The statement, your stop loss is not a failure, it is a business expense. Beginner behavior, moving the stop just a few pips to give the trade room to breathe. This is a slow-motion suicide for your account. Master behavior, the stop loss is hit, the trade is over, and the trader feels nothing. Psychology, this is loss aversion. Evolutionarily, losing a resource felt like death. In trading, you must decouple your survival instinct from your capital. Number 3, shift from prediction to reaction. The statement, I have no idea where the market is going next, and I don't need to know to make money. Beginner behavior, I think the market must go up because it's oversold. They try to dictate to the market. Master behavior, if price reaches level X and shows rejection Y, I will sell. If it doesn't, I do nothing. Psychology, this is the illusion of control. We feel safer when we think we can predict the future. Masters trade the present moment. Warning, if you find yourself arguing with the price action because a news event should have pushed it the other way, you have stepped out of your system. Number 4, the 20 trade rule. The statement, any single trade result is statistically irrelevant. Beginner behavior, they change their entire strategy after 2 consecutive losses. They are tweaking based on noise. Master behavior, they commit to 20 trades without changing a single variable. They evaluate the set, not the individual. The metaphor, a casino doesn't panic when one person hits a jackpot at the blackjack table. They know that over 1,000 hands, the house edge wins. You are the house. Act like it. The positive sign. You've stopped checking your P&L during the trade and started checking your execution quality instead. 4. Internal versus external results. Here is the hardest part of fixing your system. The results will lag behind your growth. You might finally achieve internal mastery. You're disciplined, you're calm, you're following your rules, and you still might have a losing week. This is the execution gap. The internal shift happens when you choose to follow your plan even when it's painful. The external results, the equity curve going up, only happen after you've proven to the market that you can handle the boredom of being a professional. Do not quit during the gap. The gap is where the amateurs are filtered out. 5. The story of the plateau. I remember a period in my journey. Let's call it the 6 months of nowhere. I had a character in my mind of what a pro trader looked like. High energy, fast clicks, constant action. I was trying to force the system to work. I was tweaking my ICT concepts every 3 days. Then I met a mentor who traded for a living. He didn't look like a hero. He looked like a librarian. He showed me his journal. It was boring. Trade after trade, the same setup, the same risk. Some won, many lost. But over the month, the line moved up. I decided to copy his boredom. For 3 months, I felt like I wasn't making progress. I felt doubt. I felt like the market had passed me by. But I stayed with the process. One day, I looked at my account. It hadn't mooned, it hadn't doubled. But for the first time in 2 years, the line wasn't going down. It was steady. That steadiness was the breakthrough. The system wasn't fixed because I found a magic entry. It was fixed because I stopped breaking it. 6. Final insight/call to trust the process. Fixing your system isn't a grand event. It's a series of quiet, disciplined decisions made when no one is watching. It's the decision to close the laptop when there's no setup. It's the decision to take the loss when your stop is hit. It's the decision to value your process over your ego. Quiet, consistent execution will beat excitement every single time. Trust the process, not because it's a catchy phrase, but because it's the only thing that actually works. I'll see you in the next one.